Welcome to Lending Matters. This is the Leeds Building Society Mortgage Market Podcast. My name is James O'Reilly. I'm Head of Intermediary Partnerships for the Society, and this series of podcasts is designed to be informative and topical and help maybe give some new ideas and some new thoughts on the way the market will behave in 2024. So we like to keep it topical and interesting, so we're moving quickly just to keep you engaged while you're walking the dog or wherever you choose to listen to this. I'm here today with Matt Bartle, who's Director of Products for Leeds Building Society, and obviously responsible for the teams designing the mortgages that Leeds Building Society provide. So welcome, Matt, and we'll get straight into it.
Thanks, James. Looking forward to our discussion.
So what challenges do you think first-time buyers will be facing in 2024?
So I think the challenges are the same ones or similar ones they've been facing in 2023, James. I think you've got a toxic combination of not enough houses being built to meet demand. You've got a high cost of living, inflation topped out at 10% or above 10%. Thankfully, it's now down below 4%. You've got historically high house prices, and this leads to high deposit values. The typical deposit was over £68,000 last year, so that's a big chunk for people to find. And then last but by no means least, you've got high mortgage rates, which leads to high repayments and high affordability challenges. So the barriers to first-time buyers are as they were, and I think they're the things that the market really needs to focus on. At Leeds Building Society, we've taken a number of steps to try and help with these. These will help, but you get back to the core root of the problem. It's the first thing I mentioned. It's not enough houses being built to meet the demand, and therefore the government really needs to hit the targets of 300,000 homes built per year. It's a stated commitment, but they're just not delivering on that. That said, as I say, Leeds Building Society started to try and help first-time buyers. We've partnered with Experian and their Boost products.
And it's actually somewhere where brokers have really engaged, and it's something that they've recognised the benefit in being able to boost the customer's credit score.
I'm really glad brokers have picked up on it, James, to be honest, because it is a no-brainer, so you would expect them to do. It can improve a customer's credit score, it can't make it worse, and it's free. So I'm really glad to hear that brokers are picking up on that. There's other things that we've helped with as well. So we've introduced the Reach mortgage range of products, which basically is a special product range targeted at customers who are outside of our traditional credit score band, enabling them to get on the housing ladder and to try and prevent credit score being a barrier.
And that's been really interesting as well. We've seen some of the figures for something we launched now just before Christmas and how that's performed throughout January. And it's probably been used far more than I even imagined it was. And I know we're not necessarily the first in the market with this type of service, but it is certainly something that, again, advisors are really adopting and recognise the value of.
Yeah, it has been a success, and I'll be honest with you, it surprised me as well a little bit. So I think we're both pleasantly surprised on that one. And then to help with the deposit piece, we've launched Home Deposit Saver, which is a savings account aimed at helping customers save for a deposit. Not only is it a cracking rate, competing with most of the reg savers in the market, but it also comes with a £500 bonus should the customer take a mortgage with LBS at the end of it. So that's been really, really popular as well.
Yeah, and the similar product that we've got for shared ownership savers as well. Whilst that's probably not something traditionally that the brokers are concentrating on, they're usually after that savings done. But just knowing that there are these alternative ways to help customers build up those deposits, and we all recognise that that's been a massive challenge for customers in being able to build up those deposits, particularly while there's a cost of living crisis on and all those other challenges. That additional support is just what we need.
Yeah, you kind of glossed over that there, James, but that's pretty important as well. We shouldn't forget that shared ownership's one massive way where the society helps customers get on the housing ladder. We're the biggest shared ownership lender in the country. We have, blowing our own trumpets, won the What Mortgage Shared Ownership Lender 8 years in a row. But joking aside, it is a really important and integral part of how first-time buyers can get on the housing ladder. I just wish more people were aware of it and it got more usage.
Yeah, indeed. I mean, this is what the society is generally known for is shared ownership and supporting affordable housing. But there is so much more than just that to how we support customers and what we're doing to support our purpose. Obviously, we touched earlier on just on the first-time buyer piece. Do you think this year there's going to be much in the market for first-time buyers? We've already seen hints around things like a 1% deposit mortgage or 99% mortgage, and just wondering what your thoughts were on that.
So I'm not going to sugarcoat it, James. I think it's still as hard as ever for first-time buyers to get on the housing ladder. I think if you look at the factors that are challenging, you've got the biggest problem is there's not enough houses being built. That's the cause of all of this, and at Leeds Building Society we're big advocates that the government housing policy needs to basically deliver on its promise in terms of the number of houses built. But it's not just the housing that's the problem. There's not enough houses to meet demand, yes, but there's a high cost of living. Yes, inflation dropped to just below 4%, but that's still a 4% increase year on year, and that's on top of the 10% of the previous year. So it's not like inflation is going down, it's that house prices, inflation, cost of living's rising less quickly. You've got historically high house prices. That makes it challenging because that leads to higher deposits that are needed. So not only a borrower struggling with the cost of house prices, they've got to save for a deposit. Affordability is challenging because whilst interest rates have dropped, they're still historically higher than they have been. And obviously you've got high repayments as well because, again, interest rates, whilst mortgage rates have come down a little bit, they're still significantly higher than customers are currently maturing off. So it all points to not an easy time for first-time buyers. And I do keep coming back to the fact that house building is the route out of this. You mentioned the 99% mortgage that I know was trumpeted in the media a couple of months ago, but I think that's addressing the symptoms rather than the cause, is my own view. Yes, it might help a few people out who are struggling to pay for the deposit but could afford the mortgage payments. That said, it's also likely to increase house prices further because you increase demand, you increase prices. I don't want to repeat myself too many times, but the solution is to build more houses and address that supply issue.
Yeah, and that's generally the feedback we've seen within the broker community as well. So whilst any impetus in the market like we've seen recently with things like stamp duty, holidays and that type of thing, it does create a very short-term bubble. And I think we've, as a market, we've been living with those over the last few years, but it does feel like it's time for something a little bit more stable and a bit more long-term thinking than some of these sort of short-term interventions and issues like planning and issues like the number of houses being built. All feel like sort of big, sizable issues that need to be tackled.
I think house building is obviously the key point, but there are things that I'm not saying the government's been terrible around the housing policy. You look at some of the support they've given to first-time buyer. Help to Buy has been a great scheme. The Lifetime ISA is a great scheme. It could be better. I think there's improvements that could be made to that to make it even more beneficial for customers. We've not seen a massive take-up on it, and it could be simplified to incentivise more deposit takers to sell it. But you've also got innovation from lenders. Clearly, we've launched a number of schemes at Leeds. The Reach mortgage, which is effectively a scheme where products are made available to customers who are slightly outside of our usual credit criteria, might not have been able to get a mortgage otherwise, but are able to do so through Reach. We've also launched Home Deposit Saver to help people save for that deposit that's a challenge, so that hopefully they can get to the 5% rather than 1%, and looking to help them with that. On top of that, there's Experian Boost, which I'd encourage everybody to sign up to because it's a no-brainer. It's free, it can make your credit score worse, it can make it better, and again, it just helps people get back on that housing ladder. So there's lots of innovation going on in the market. There is some government help that's worked, but house building.
Yeah, indeed. I once sat in on a session with Lord Willits when I was at an IMLA meeting, and he actually talked about how if you could interpret the figures as almost like an intergenerational issue, in that it's actually older generation have now got all the capital, all the property and everything owned by them. And then when the crash happened in around 2007, 2008, all the rules that have come in since have been to completely de-risk the fact that they've now, their investment and their holding of all of those properties. I'm not sure it's quite as sort of conspiratorial as that. But it does feel at the moment that certainly those looking to buy a home are struggling to find the way in. So some of the barriers around there that certainly the society help with, and that we've been a leading force on for so many years, has been in shared ownership, and it's an area of the market that the society has been associated with for a long time. Obviously, with the end of Help to Buy, I think there's a lot more eyes being on the shared ownership scheme, and I just wondered from your perspective, was there any, if you had a wish list of things that could be done for shared ownership, is there anything in there that you might reach to?
There's a few things, James. I think I think the shared ownership scheme is fantastic for helping people get on the housing ladder. Therefore, it fits perfectly with our purpose. It's no coincidence that we are the biggest shared ownership lender, and get a shameless plug in that we are the best shared ownership provider 8 years running from Mortgage. I think the biggest problem with shared ownership is lack of awareness. I think there's a distinct lack of awareness and understanding of what the scheme does. And I think that's the biggest barrier for people using it. I think it would get used far more if particularly, I think brokers understand it broadly, but I think there's a lack of consumer awareness about it. So that would be the big thing for me around shared ownership. I think, yes, you can tinker around the edges with the rules around how much you can staircase buy, etc. But I think fundamentally the scheme is sound. There's potential for changes in terms of who we're allowed to set it up. Typically, it's housing associations, but private shared equity, shared ownership is another way that the market may go. But I don't think there's a great deal wrong with the shared ownership model. I just think that awareness needs to be improved, and that education piece is really where we can help.
Yeah, absolutely. I mean, it's been an increasingly competitive area. I mean, our sort of history was probably at the 95% LTV for the borrower's share, and obviously that's a busier area now in the market than it has been. But we'd gone for quite a long time before rates had started coming up quite as fast as they did over the last couple of years, with 14 consecutive increases in the bank base rate. So now, there are going to be considerations around arrears and various things like that we are going to be facing into. Do you believe that's going to be a real challenge for lenders this year or the market this year?
It's a really difficult one, that, James, to be honest, because I think we all expected that to manifest last year, because, as you say, that's when base rates started to rise. And to be honest, we did see an increase in arrears of up to sort of 30% in 2022, but they're still at historically low levels. So it does look at the moment like households are able to shoulder that burden of the higher mortgage rates that have come through. We certainly at the society will do all we can to help those struggling with repayments, because it's the right thing to do. It removes uncertainty, and it's right to protect something that our members have worked for to buy over a number of years. I think that the worry for me is that there are still a significant number of borrowers who took out a mortgage pre-2021 and will be paying rates of 2-3%. I think the average rate in January 22 was 2.38%. That when they mature, they're going to have a significant increase in their monthly payments. A typical £200,000 mortgage over 20 years, payments will increase by about £300 to £400 a month. That's a significant amount of money that households are having to find. So that's the challenge. I think we have seen a lot of these customers mature and go on to higher rates, so we're not starting to see the arrears tick up as quickly as we might have expected, but there is still a big chunk of customers who will be remortgaging this year and next year who will have significant increases in their payments. We offer product transfer products and I'd encourage all, I'm sure brokers will be doing this anyway, encourage all customers to take out product transfers, because you can make a significant saving by taking a product transfer with Leeds Building Society over going onto the typical lender's reversion rate, or look to remortgage to Leeds. As I say, we've got a number of options around remortgage customers, but definitely customers should be looking to take a product transfer as soon as they hit their reversion rate. That's the way they can help mitigate this payment shock. But back to your original question, arrears are likely to impact.
Yeah, indeed. Actually, the Society are moving product transfers onto our Mortgage Hub system this year. So I think brokers will find that the process for doing product transfers a lot simpler. Obviously, as rates have come down, product transfer rates have come down at the same time. So as you say, the payment shock shouldn't be as bad as maybe it has been during last year. I think sort of one of the things that brokers are struggling around with a market moving quite so fast is lenders repricing very quickly. Obviously, that affects on the product transfer side as well, because they're often sort of trying to keep on top of that and move them onto the most relevant product. On top of that, we've got things like consumer duty introduced last year settling down. Behind all of this, the mortgage charter that we're heavily involved in and obviously working through gives customers an extra bit of support from government to support them at that time. So yeah, I think on for this year, it does feel like there's a certain amount of optimism, particularly given how tough 2023 is. That 24 will be maybe a slightly calmer year, but it's difficult to forecast anything with a budget and a general election likely coming during 2024. So really, I just wanted to bring the podcast to a close and say thank you, Matt, for your thoughts. It's been a sort of an interesting conversation. Hopefully we've given you some insight into what be coming in later on this year and some of the key issues that are affecting the market. So thank you very much for your time, and see you again soon.